Walmart is out with its fourth quarter and its full year results. Earnings $1.38 adjusted. That's below consensus estimate of $1.43. Revenues also below at $141.671 billion. Analysts had been expecting $148.488 billion. Now, there is a negative impact on sales and profit due in part to continued unrest in Chile. The majority of the stores there actually saw disruption. Some, I understand, completely destroyed, so that's going to have an impact. The initial full-year earnings guidance, this is for an adjusted 5 to 515 compared to the current 522 street estimate. So the retailer is holding an investor day. They'll be discussing this more in depth further this morning. We should note that shares are down here about 2% in the early going. Now, Walmart's U.S. comparable sales growth streak, that does continue, up 1.9%, though also below analyst expectations for growth of 2.3% for the quarter. U.S. e-commerce net sales, not comparable, but net sales, these grew 35%. In the coming year, expectations are for this metric to grow at least 30%. Now, I spoke with CFO Brett Biggs. He said, quote, the quarter started and ended strong, despite softness in some categories like media and gaming in the weeks leading up to Christmas. Biggs added the new year has started off well. We're just 18 days in. Now, on the coronavirus, Biggs says that Walmart is monitoring the situation and focused on the safety and well-being of customers and associates. But Walmart stores have remained open in China. He says sales are still okay, though the mix is geared towards food. Further, Biggs said right now, Walmart is not seeing any major impacts for the U.S. from the coronavirus. And also right now, the coronavirus impact is not factored into the full year guidance. Biggs also said the guidance for the year, though, does reflect an expectation that e-commerce losses will be flat to lower compared to this year we just ended, and that global net e-commerce sales will approach $50 billion. Now, during the Walmart Investor Day in the 9 a.m. hour today, I'm going to be sitting down exclusively with CEO Doug McMillon. So there's going to be a lot more to talk about the year that just wrapped up and the expectations for the year to come.
At 9?
At 9. I know. Investor Day starts at 8. We're going to get him in the middle of Investor Day. It's going to be a busy day for Walmart.
Couldn't do 8:30?
Couldn't do 8:30.
Couldn't do 3:30 p.m.?
No, couldn't do 3:30 p.m. It was the way things worked out with the scheduling.
Courtney. Okay.
But here I am, Joe.
You are. There's no it's boundaryless behavior. That was.
And I think I'm going to come back even later in the show.
And we look forward to it, Court. Thank you very much indeed. Sure. And let's pivot and talk to Charlie O'Shea now, retail analyst at Moody's, who will be with us to discuss Walmart. Also with us for the full first hour of the show, Joanne Littman, Distinguished Fellow for Journalism at the Institute for Advanced Study at Princeton, also a CNBC contributor. Charlie, so the shares clearly trading down. There was quite a lot of downbeat sentiment from the analysts coming into this because of Target and others.
Right.
Clearly not enough priced in, though.
I think this holiday seems really fluxy to me, and that's a technical term, I guess. You saw Costco's numbers. The sales numbers for November, December blew the doors off, 8% plus comps for the 2 months. That kind of set the tone that maybe Costco would get some revenue. Target's numbers, the sales numbers, a little bit disappointing in some categories, but good in others. Walmart, I think that's what we're seeing. Amazon had a nice quarter, but took a 150 basis point margin hit to drive those sales. So we knew we were getting a highly promotional holiday season. We knew the big guys were spending a ton of money on shipping and everything else. And I think that's flowing through everybody on the expense side.
When do we get past the worst of that, given there's been a lot of competition, as you said, to get the online sales up to speed? When do the margins bottom and start to improve meaningfully?
I think potentially back half of 20. I don't think you'll see it over the next couple of quarters. Amazon will likely be spending on its delivery initiatives throughout 2020. So that kind of sets the tone for everybody else to compete with Amazon in the online business. From a brick and mortar perspective, Walmart's in really good shape, Target's in great shape, Costco, Best Buy in really good shape on the brick and mortar side. But they're still spending. And when you build an online network, you're building a second business. So there's still a lot of cost overlap happening for everybody. And you start to see that kind of winnow out over time. But we're not there yet.
U.S. comps, 2% or so, just under that, was expected to be more like 2.5%. Is there any fears at all of the consumer, or is that still pretty strong?
I think that the area that's kind of a mystery to me is the toy business. I think that we saw Target comment on toys being soft during the holiday. I think the absence of Toys R Us has kind of dampened consumer behavior with respect to toys. There's no place to go anymore for just toys. So they're kind of spreading things out. There was no super hot toy this holiday. So I think that's the area where I'm seeing the most softness for the holiday.
And in terms of your overall rating, where do you end up on this?
Walmart's still the highest rated retailer in the world. It's a AA2. Costco's a AA3. We just took Amazon up a notch with a positive outlook to A2, which gets Amazon into the prime one commercial paper category. Mm-hmm. So the higher rated retailers, Target's an A2. The higher rated retailers are continuing to perform pretty well at the expense of the guys at the other end of the food chain.